Hi guys, welcome back to the channel. My name is Dave, and covered call funds continue to evolve. At first, we had funds that were selling very simple at the money calls out 30 days, trying to collect some income. Think XYLD, QYLD. That's kind of where it got started. But over the last few years, we've seen sophisticated improvements to the process. And we're trying to capture a little bit more upside. It's worked out well for us, the investor, because we're creating competition. And as I look at results are improving. The new funds are outperforming the old funds. And that brings me to TSPY from TappAlpha, which I recently reviewed. And I find TSPY to be an interesting product, although it is brand new. But with the flexibility and technology built into the fund, I'm intrigued. For example, they use 0 DTE options, which is not new for these types of products. We've seen that for a while now, but they will also adjust the strike price for known historical events, like the Santa Claus rally that we just had back in December. So will technology and adjustments like this have an impact on the fund? Will we see outperformance? It is a brand new fund, so only time will tell. But I'm curious enough, so I reached out to Si Katara. He's the founder of TappAlpha, and he was nice enough to come on and talk to me about his background, the fund, how it developed. So let's talk TSPY. If that is what you're looking for, please stick around. Thanks for joining me today, Si. I really appreciate you coming on and taking the time to talk to me about TappAlpha. You are the founder, and your first ETF is TSPY. TSPY is the ticker. So I guess first thing is I want to hear about your journey here, about your background, what you did before this, and what brought you to starting TappAlpha, along with your decision to roll out TSPY as your first ETF offering.
Yeah, thanks so much for having me, Dave. It's been a pleasure to sort of watch the videos that you've done and the education you're providing for the industry. So I really appreciate the work you're doing. Yeah, I came from a totally different world. Came from a technology background, so ended up studying computer engineering. Went to work for a startup in Silicon Valley in the early 2000s. Loved the startup atmosphere. Was sort of a hardcore programmer, embedded systems, computer engineer, on the keyboard and working in the startup world. That company ended up getting bought by a big company, by Cisco Systems. And I love the small company feel, just the ability to make an impact where you are. And I felt like a tiny cog in a huge machine at Cisco. So I was lucky enough to have a little bit of a buffer after that acquisition to end up starting my very first founding position at a company. So I started a company that was in construction technology back in 2005, and I built it and ran it until I guess it was 17 years. So it was a long time.
Yeah.
But everything I learned and everything I did, it really helped me sort of figure out how do I like to make impact in industries that I serve. And the common thread was always, how do you take innovation in order to disrupt existing industries? And so that same thread kind of led me to where I am now. So I'd always sort of been interested in options, always in trading. My dad was also an engineer turned financial advisor. And he taught me sort of everything I knew about options trading and things like that. Early in my trading experience, I was on the buy side of options, and I got bit pretty bad. So I learned the hard way. The buy side is hard, and with my risk profile, actually selling options might have been a much better fit for me. So I ended up leaving the company that I founded and was ready for the next adventure. I knew I wanted to do something in finance and technology, but one of the challenges was the practical impacts, like how do I make ends meet? And this was October of 22, and I'd always kind of been an S&P 500 buy and hold investor, just, and it served me well because I was busy running the business. But October 22, the markets were way down.
Mhm.
And so I was trying to figure out how do I make ends meet? And then to add to the pressure, 4 months from that date, we're going to have our first baby. Our baby girl is going to be born in February. And so I was like, well, I know you're having this career shift moment, but like the timing isn't great, buddy.
Right.
But we we had to make it work. And so I remember the strategy my dad had taught me with covered calls, but I think the perfect storm that happened at that time is daily covered calls just became available on the S&P 500. So I was like, all right, let me try this and see if it amounts to anything. Well, fast forward 2 months, just the options premium on top of the SPY shares that we owned ended up covering the lion's share of our mortgage. And that for me was such a financial relief. And I was so grateful for the strategy because, my daughter was born in February and I felt like I didn't miss a thing. I was there for all of it, her first year. And it was such a special time for us and our family. And one of the main reasons I didn't feel that pressure and why I could be so present was because the strategy helped us do it. And the thing that I was able to develop before she was born, it took a lot of time, right? It took 3 to 4 hours a day because I
Right.
would do a lot of math to figure out risk reward to see where my daily positions were going to be. But with the software background, I ended up being able to write some tools that helped me take 4 hours of work down to under, 5 minutes. And that was sort of the aha moment where I was like, this is the next business. And that feeling of just financial relief, I was like, look, if this is helping our family in this way, like I want to find a way to take this value and help other families like ours. And so that's how the idea of TappAlpha came. And the other idea too embedded in it was just access. Like I thought about how lucky I was, one, to have time to do this, and then two, to have, the education about covered calls and finance that not everybody is lucky enough to get from their families. And I thought if I can take this expertise, be transparent education on the topics in it, but provide tools along with that education to help others take advantage of it. That's the whole idea of Tap Alpha, was giving access and tapping into these financial strategies that are really powerful, but they're just hard to do or hard to understand. And so how do you create access to financial opportunity for everyday investors and advisors? And that was sort of the nexus of the founding of the company. TSPY is a good instantiation of that idea. And so we ended up launching that on August 15th of this last year, but it sort of encapsulates that idea, how do you take this value? And we're trying to find the best way to get it to market. Do we actually license a fintech product where you attach your brokerage account and make it work? Or do you wrap this value inside the structure of an ETF? And we chose to do that because it seemed like the most friction-free way to deliver that value directly to people's brokerage accounts. So August 15th, TSPY was born, where we do exactly that. We own shares of the S&P 500 encapsulated in SPY because of the liquidity there. And then we just sell zero-day options in the morning that expire same day. And we do this every day. And we just harvest little bits of options premium in order to help generate the income, mitigate some downside risk, and provide added value on top of being a vanilla S&P 500 fund.
That's quite the journey you've been on since 2022 and having your firstborn come into the world. So pretty interesting. So that whole process then was a couple of years from when you decided we're going to start TappAlpha and creating that first ETF and bringing it out to the market. So is that about right? Was it hard, I guess, with all the regulations and stuff with ETFs to bring that to market with not having a background there yet?
Yeah, it was interesting. I got to give myself a little grace because I'm impatient when it comes to getting things kind of done and accomplished. So when we finally decided that doing an ETF was sort of the path, this was November of 2023. And so we actually registered with the SEC, the product, in November. We ended up becoming SEC effective in February, but the challenge, we didn't launch till August. And, I was trying to push and get things done. The challenge was because the strategy was zero-day options, it's very frequent. And this process, you've got this big machinery behind you when you're doing it inside of an ETF, because you've got custodians, you got prime brokers, you got executing brokers, you have accounting, and all these things have to talk. And the thing about the ETF industry, and this is, I think, part of the opportunity, a lot of this stuff is still manual. It's still spreadsheets or emails or, manual conversations to get things done. And so we ended up automating a lot of that inside the underlying fintech in order to get all kind of parties connected. So it just took longer for us to get the fund launched than we wanted, but it was November to August to actually get TSPY up and running. And now that we did, I'm so glad that we actually went through that process, because the implementation we were able to come to market with is exactly what we wanted. The hard part was owning real shares of SPY, because that lives in the custodian, but then the options trading happens elsewhere in the prime broker and the executing broker. And obviously you have to collateralize one with the other. So that connection was really hard. We actually even had the first custodian couldn't do it because their processes wouldn't support it. So we had to find a new one. And I'm really glad that we did, because now the full process is like a well-oiled machine. But we were the first ones through the wall to do it, to actually own SPY shares and execute the strategy. So happy with where we ended up. It was definitely a process to get there, with a lot of pain being the first ones through the wall. But I think now that we've established this process, future products and even other ETF issuers hopefully will have an easier time.
One of the things that attracted me to this is you call TSPY a fintech-powered ETF. So there is some intelligence behind what's going on there. So what, in your mind, what sets TSPY apart from maybe some of the other S&P 500 covered calls funds that are out there right now that are currently available?
I think one of the biggest differentiators for TSPY is our goal is to provide income for today and growth for tomorrow. I think a lot of the other funds that are out there are very income focused. So just as an investor, just deciding, okay, what's my goal? If I need a lot of income right now, there's good products that can provide you that sort of monthly distribution. We decided to stay sort of balanced, where we're able to provide some income, current income today, in the range of between 13 and 14% annualized. But we also still are focused on trying to capture as much, and hopefully with good performance, maybe even more than the underlying security in the S&P 500, and keeping that growth within those shares, which has a lot of benefit. So that's one of the main differentiators, is the focus on both income and growth. The second piece is the fintech is a really big differentiator. And the reason is, when you're doing 0-day options, it's pretty frequent. You're doing trades every day, and the markets are dynamic and they're moving. And so there's a lot of inputs that you have to be able to process very quickly. And when I was doing this manually, it was a lot, because I'm looking at volatility, I'm looking at historical performance, I'm looking at volumes, I'm looking at all the Greeks, and all this data is coming in to tell you simply, here's the reward, and then what's the risk? And it's that calculation that's very challenging. Fintech, now we've codified it, can do it in real time. It takes all this input and it just tells you very simply risk reward. Then it's very easy for me as a portfolio manager to look and say, yes or no, is this within the risk profile of the fund? And then you click the button and it does the rest. So that's a really big differentiator I think for us, because it's basically, it's innovation, it's automation, it's AI, plus a human touch to really manage a frequent trading strategy in order to get better outcomes for our investors.
Some of the first ETFs that came to market, these covered call strategies, were very basic, selling at the money or slightly out of the money. Same thing, monthly options, and see what happens. So I've been drawn to it because it's more how I would react as some of the trades options. Is I'm going to go in, I'm going to determine what strike price I want to sell, and then I'm going to be cognizant of what I actually purchased those shares at, and as I'm selling these too. So we're looking at a more holistic approach to when I'm making these trades. So let's talk about the makeup of TSPY with that in mind, then focusing on the option strategy. So you mentioned you own SPY shares, simple enough. Then you're going to sell 0 DTE out of the money, index call options. But you've added into the prospectus here some flexibility, right? So you can manipulate that trade during the day. You can even roll it out a week, even though you're using 0 DTE daily options. So walk me through that decision a little bit more for placing this trade. You did say you do it in the morning, right, for the day. And so you're selling it in the morning, closing it out by the end of day, or letting it expire, or you also have options to roll it out. So can you kind of walk me through how you make the decision?
So once we take a position, the technology sort of helps us monitor that position. And that's a really critical component. Like taking a big step back, we try to shoot for 80% of our trades that we make will expire worthless, which means we get 100% of our premium. It's the 20% of the time that you've got to figure out, and that's when the strategies win or lose. So having real-time monitoring is really important to make sure we can mitigate risk. So there's two things that we'll do. Today is actually a really good example. So we set a position in the morning. Well, if we get 98, 99% of our returns, we'll close out the position early because we already won. Mm-hmm. So that's one of the reasons we'll close out. Why stay risk on if you've already won? Because especially on days like today when volatility is high. So that's one of the things that we'll do. And then if it's early enough, sometimes the market gives you additional opportunities. So we can even, and here's my bad analogy for the day. Ima- Imagine a spotlight, and in that spotlight, it's basically a risk reward spotlight. So the the fintech will basically showcase, hey, the market is giving us an opportunity, and you know when it shows up, you can grab it because it matches that risk reward profile, and that allows you, based on where you are later in the day, whatever the market's doing, if it gives you an opportunity, there's a chance to take it in order to sort of add some additional incremental premium. The flip side, when the market goes against you, that's really important. So there's two things that can happen and why you'd want to close out early. One, if the market's going against you and you want to limit risk, there's triggers that basically say, hey, we're out of our risk profile. With volatility, with momentum that are happening, like it's probably a good idea to close the position, just take the loss and move on the next day. Sometimes you get upside down, so the market will exceed your strike. And depending on what the technology kind of says and what the markets are saying, sometimes you can actually do exactly what you said, roll it out, either a day or more than one day, in order to sort of let the market level out. You get some time premium, but it mitigates the loss by doing kind of option rolls to future days. So essentially, the reason we close out early is, in those cases, is it's a risk management strategy. And we have, because of the implementation of the fund and that we're super dynamic, we're able to do this stuff pretty quickly, especially in the confines of being in an ETF. It really gives us a lot of tools in our tool belt in order to mitigate risk, to try and really help deliver on the returns for investors in a risk appropriate way. That's really the name of the game. How do you manage risk, and what can you do to make sure you can protect that downside?
Yeah, I looked at the trade for today. So the call for today was set at 59.15, and the index is currently trading around 58.20. So do you still have that order open, or did you already close it for the day?
Shut it down, yeah. So we sold it for, I think, $2.70, and we closed it for 10 cents. So we made all of it essentially,
Okay.
except for 10 cents. And then now that the technology is kind of looking for, are there other opportunities with the time that's left that are risk appropriate to maybe collect a little more premium? But otherwise, we take our winnings and we go home.
Okay. So yeah, today is January 14th for those that might be watching. We opened up, but then we dropped pretty sharply there for the last mid morning. So I was curious about that. So
Mhm.
that's one example of closing early. Do you have any other examples where your decisions intraday changed what you were going to do? Do you have any examples?
Yeah, so there's been occasions where I'll give you, we might as well go through it. It's the Achilles heel of these strategies.
Mhm.
And the Achilles heel is when markets are doing a bull rally and they do it sustained over multiple days. That's hard because you keep getting capped out. And so our strategy dynamically sets a different position based on all these inputs. So we might write as close to the money as 1/3% out of the money, or we might write it as high as 1.5%. It just depends on the volatility and a lot of input factors. Well, right before Christmas, there was the 20th, the 23rd, and the 24th.
Mhm.
Everyone was talking about the Santa rally.
Yeah.
Santa rally is 7 days and historically 1.3% upward movement. So we're like, okay, strategy can handle that. But what happened was, over 3 days, the 20th through the 24th, the S&P 500 went up 3.1%. So it was twice as high in half the time. And so what happens in those cases with these strategies is you can get capped out and not get, the full potential of those rises. So that's a good example of the roll strategy where we ended up getting capped out, but we rolled the option forward, and um, and then basically you saw what happened later after Christmas. Things kind of leveled out and came down. So the roll allows you, it buys you more time, it smooths out the ride, and then when the market corrects or comes down, you get a chance to sort of get back caught up with market levels. And so that's one occasion where the roll strategy actually helped us. It it was uncomfortable being behind the market for more than 2 or 3 days from the human perspective, but I think that's the thing that's really nice about the guardrails and system in place, it kind of takes the human emotion out of it. You just got to trust the process. And sure enough, things came back and we settled back in, and we're off and running after that 3-day period. But that's a good example of the defensive actions and how the strategy and the innovation kind of come together to keep it a smooth experience and accomplish the goal for what the fund has.
More complicated than saying I'm going to sell a 20 delta call option. You're looking at a lot of other variables here that are feeding into your system and making
Correct.
that strike selection. Yeah. Cool. I like that. So now you touched on target distribution rate. You said around the 12 to 14% rate is what you hope to do. And do you hope to hold that pretty solid? I know I get lots of questions from income investors that are hoping for consistency. But some of these products try to distribute more real income versus a set amount. So what's the strategy with TSPY?
Yeah, I think what we've heard is the same, where people really want reliability and consistency. So our goal is to sort of create a smooth income distribution based on, of course, what the market gives us and what we're able to do. But so far, we've sort of been right there, similar distributions every month, 29 cents, 28 cents since the beginning. And we're going to continue to try and be consistent with it because I know that's an important characteristic, especially if you're relying on the income, post in retirement or for whatever you need. Same thing in my personal experience with it. Having sort of the reliable income from the strategy was really a game changer for us. And so we're trying to accomplish the same thing with the fund.
How about touching on taxes real quick? I know there's probably some things you can't talk about, but do you expect a lot of these funds, you do see return of capital, ROC, when taxes finally get settled. There's also 1256 contract benefits from your index options. Can you talk a little bit about that?
Yeah, I'll do the disclaimer first. I'm not a CPA. So these are just questions to ask your tax consultants and your CPAs. It's really interesting the way we're able to implement the fund. So you've seen some others that do synthetics, for example. There's some interesting tax implications for that. One of the coolest things about owning SPY shares within an ETF is the fact that you can take advantage of in-kind redeems. So if this is too complicated, we can change the subject. But basically, one of the big challenges when you do a covered call strategy is it can be subject to straddle rules. And when you have a straddle, you're taking a hedged position on an underlying security. In my individual account, when I was doing this, what happens is it pauses the capital gains clock on the underlying shares. And if you're doing this every day, you never essentially get to long-term capital gains consideration, even if you hold the SPY for more than a year. But when we started to do this in the ETF, one of the biggest tax benefit that we actually discovered was the fund's goal is to not sell SPY shares. We just want that to grow. Right. And if an investor owns a share of TSPY for more than a year, and let's say they sell it to sort of realize the underlying capital growth, those shares never actually realize a gain because they're handed back to the bank in kind. So that short-term consideration potentially gets wiped away, and all that the ETF investor has to pay is deferred long-term capital gains on the underlying growth. So that is a huge tax benefit potentially within the confines of an ETF. Again, consult your tax accountants for that. That was one of the reasons why we really wanted to own shares. The second thing why we wanted to own shares was we also distribute dividends. SPY provides dividends quarterly. Those are coming straight to investors as well. And then the third thing is at the end of the tax year, if you have a synthetic, because it's a 1286 contract for the underlying, those funds have to, because of the ETF rules, they get marked to market, and essentially you have to distribute 90 plus, effectively 100% of the gains on both components of the strategy. If you own shares, it's basically like an icebox or storage for your capital gains that can be carried forward beyond the end of a fiscal year. So there's some really interesting tax efficient benefits to owning the underlying shares. And then the other component is obviously the 1256 income, which can be taxed at 60/40 with some other complexities of the rules. But That's one of the main differentiators on owning real shares versus doing synthetics or something different.
All right, so we'll see how that all shakes out here once we get our tax statements at the end of the year.
Get ready to live. Tax
It
season.
is upon us. All right. So TappAlpha is a new company. It's less than a year old, and after my initial review, I received lots of questions about, hey, this is a new small outfit here. They just got started up. What about security? What could happen to this new ETF that just came to market? What happens if Si gets a runny nose and doesn't show up to work for a couple of days? So what's in place to make investors comfortable with a new company like TappAlpha?
Yeah, it's a good question. The biggest thing for folks to know is that um, there's a big network of organizations that are helping run the fund. So we partnered with US Bank for our custodian. So that's where all the resources are held. We partnered with a trading sub-advisor that's done this for years. So if I go down, they actually are the ones that can help execute the trades, even if I'm not available to push the button. They can sort of step in. So we have redundancy there. We've got an executing broker, GTS, that actually does the execution trades, and then the prime broker who actually clears it, called ClearStreet. Um, and then there's a CPA that helps us do all the audits and tax. So there's this big network. There's probably 30 plus people across these organizations that help run the fund. We are the portfolio manager and sort of brought the idea to market, but there's a whole team of really talented people that help us run it. And we have a redundancy plan in case one single point of failure goes down, that others can step in and run it. And then the worst case, knock on wood, this never happens. But like, let's say TappAlpha doesn't exist someday. The great news about what we own is it's SPY, which is the most liquid ETF out there, and we're doing it using SPX options. So all of those assets are highly liquid, and so even if TSPY for some reason doesn't exist, the assets within them always will, and they're safeguarded by large custodians like US Bank to make sure people are safe.
But what's on the horizon? What do you plan to do next with TappAlpha? Do you have some new products that you hope to bring to market?
Yeah, it's been so fun being a part of this industry now. And the coolest part is kind of the interactions and the back and forth. So to answer your question, the new products, there's this long list that are starting to aggregate because of demands and market demand that we're hearing from people. So the first one that we actually already have SEC effective is the same strategy that we're doing in TSPY. Just do it on the Qs, so NASDAQ 100. So that's already registered, ready to go. We'll likely launch it when we get to a certain minimum AUM in TSPY, prove the model, and then we can stamp out TDAC in a similar fashion. The other things that we've been asked to do are around distributions. So we've had people that are like, we want to do weekly distributions and we want to do it at a high distribution rate, 25, 30%. So I hear it. That would be a different product if we ended up doing that. And we would probably structure it differently too, because the goal of TSPY is income and growth, not pure income. So I can see us doing potentially different distribution levels of products. I've also heard the other side, because we talked to a lot of advisors too, and they're like, oh, you guys actually have some potential maybe to outperform the market. Well, that would be huge over time as a growth product, but we don't want distributions. We just want it in the fund. So creating one that's like T Grow, that's just growth and not growth plus income. And then we've also heard the demands for like T Net, which would basically be, we're worried about where the market is. Like, if there's a big event, what's our safety net? And so creating a product that would potentially do this strategy, but then buy puts in order to cover the downside. So you give up some of that additional income and growth to create your safety net in order to sleep well at night. So we've heard those sorts of opportunities. And then the real underpinning, since there's this underlying fintech that scales to, and it would support all of those products, building that out in a way that we could also provide the capabilities to advisors, for example. I've heard a lot of people that are saying, we manage these separately managed accounts, but we just don't have the bandwidth to do options trading, but we see how much value it can potentially add. So using this innovation, to enable folks to do this in their advisory SMAs on any underlying securities, but having it, partially automate the process to add options income to a wide variety of underlying securities. So that's, we're figuring out the sequence of all those things, but the fintech is the heartbeat of the suite of products that we're able to provide. And it's just a question of, I don't need to be necessarily the one that brings them all to market, you know, but we do want to be able to provide the value in our expertise encapsulated in the fintech to help maybe potentially others bring it to market. So we're open in that regard, but immediately you want to prove the concept with TSPY. We want to prove it with TDAC, and then we'll see where the market takes us.
TDAC. So we'll keep an eye open for the NASDAQ version of TSPY. Is that probably 2025?
Yeah, fingers crossed. 2025. We'll get it out there as soon as we can. As soon as we hit our AUM targets, it'll be on deck next.
Awesome. Okay. Well, thank you so much for joining me and talking about TSPY today. I really appreciate it. Fascinating product. Love that you came on and you're talking about it and kind of getting the word out there. So thanks so much.
Thank you for having me, Dave. It was great. I enjoyed it.
So a new interesting fund to consider. Let me know what you think about TSPY and TappAlpha down below. I'm sure Si would love to hear from you as well and get some good feedback, positives and negatives that you see. So let me know down below. If you like this type of content, like and subscribe, and we'll see you next time. Thanks so much for watching. Have a great day.